Good afternoon, good afternoon, and hello, and welcome to this edition of Who Moves the Market. Well, guess what? After this mega event that everybody was holding their breath on, the market is not really moving at least too much. We've had a pretty flat session so far. But it's not about today. It's about how you look at your investments and this market over the next several months, given the extreme news flow, the headlines, and the volatility. Well, who better than Nilesh Shah, MD at Kotak Mutual Fund, to help us navigate some of these issues that the market has been grappling with. Nilesh, it's always a pleasure to have you in, and today we really want to do a bit of a classroom to go back to Basics 101, because if there's one thing that 2023 has not been, it's an easy year in terms of making money. And that follows from 2022, which had its own challenges. So a lot of investors are wondering, hey, what's really going on? Well, your opening thoughts, and welcome to the show.
So thank you, Surpi, for having me over here. In real sense, making money is always difficult. If not, all of us would have become millionaire.
True.
The thing about making money is that it requires incredible patience. It's like birbal ki khichdi. Pakne mein time lagta hai. Someone questioned Warren Buffett that there are so many books written on you. Is there any secret of your investment style which is not known to the world? And Warren Buffett replied, no, whatever I do is known to everyone. And then next question was, then why have everyone not become as rich as you? And he says, everyone doesn't have the same patience which I have. So making money is difficult. It requires patience and it requires discipline. If we have combination of this two, discipline and patience, then making money is easy. Else it is difficult.
Fair point. And Nilesh, we're having this conversation on a very poignant day. It is the 23rd of March, right? And we all remember what happened to our country, to the world at large, 23rd of March, just 3 years ago, 2020. We got these lockdown announcements, a never seen before scenario. And as difficult as that period was for humanity, for us as people, I think that was also a time where a lot of new investors got in the market and they thought it's a very easy ride. Because 2020 onwards, I mean, that 7,600 odd on the Nifty, from that time onwards, it was almost a one-way move. But as I said, 2022, I think, has been a reality check. Just your thoughts before we get down to the specifics on whether the market will keep testing people's patience like this whole sideways movement that we've seen, sideways to actually slightly negative. We're down 5% this year.
So the beauty of stock market is that it's like a bamboo tree. In bamboo tree, you know that for 5 years, there will be no growth. In 6th year, it will become a very, very tall bamboo. In stock market, many a times, we don't know when that 6th year is. Is it the 1st year? Is it the 5th year? So there are years of moderate return, negative return, low return. And then there is a year when you deliver much higher. March 20 was the bottom of the market. And it delivered great return in calendar year 20 and 21. But 22 was going nowhere.
Yeah.
So again, that patience and discipline both comes into play.
So let's come to the here and now and the factors that people need to understand and bear in mind, as they take their decisions. I want to start by getting your thoughts on this big announcement from the US Federal Reserve, because, by the way, I was awake till 12:30 following the Fed commentary and the press conference, and everything was good. The US market was at the day's high. It was, as expected, it was a dovish hike as the market wanted. And then everything changed because of Janet Yellen's comments. So first, just your thoughts on the way markets have interpreted these big announcements coming in from policymakers, both in Europe and then, of course, last night in the US.
So if we see Fed is caught between devil and deep sea. If they raise interest rates, the debt to GDP ratio of America at 105%, the student loans in excess of $1 trillion, the credit card loans in excess of $1 trillion. I mean, all those debt burden will crash the economy. On the other end, if they don't raise interest rates, inflation will remain elevated and undermine US economy. What does Fed do? They have to maintain a very, very delicate balancing. They are raising interest rates with the hope that it will curtail inflation. And they are not withdrawing liquidity at the pace needed with the hope that it will stabilize growth. It will not allow growth to go down dramatically. Now, this strategy worked wonderfully till such time accident like SVB didn't happen. The side effect of rise in interest rate is losses on treasury portfolio, where you invested at 0.25% and 0.5% and 1% for 10, 15 years. And now interest rates are heading towards 5%. How do you account for mark-to-market losses? Now, the only way to account for mark-to-market losses is, whether you have net worth or if you remain liquid. Fed, by maintaining liquidity, was ensuring that no bank will be short of liquidity. But then net worth also is needed. And this is where US Treasury and FDIC come into play. They have to guarantee the deposit holders so that integrity of US banking system does not come under pressure. Now, in some sense, market has built these expectations. Fed will walk left and talk right. They will raise interest rates, but they will not take out liquidity at the pace needed. And whenever there will be accident, US Treasury and FDIC, along with US Fed, will come to rescue the depositors. If there is any deviation in these three expectations, there will be corresponding impact on the market. This is the game which is being played out.
Yeah, absolutely. I think we'll just put up that quote for the benefit of viewers who are watching this program. Why there was so much of a shuffle in the market yesterday, because during his press conference, during the statement, the Fed chief actually said that all deposits of Americans are safe. And that gave rise to hopes which are already in the market that the Fed or the Treasury is standing behind all deposits across American banks. But that was quickly thwarted by the Treasury Secretary. When Janet Yellen spoke at a separate event, she was speaking at Capitol, she went on to say that at least right now, she is not considering any blanket insurance or deposit guarantee scheme. And that's when the market turned. Just in case you're looking at the specific details of what transpired in the last 24 hours.
Left right kind of scenario.
Oh, yes, absolutely. And we need to see where the twain meet, where the twain shall meet, as they say, right? And get more clarity on it as we go along. But, Nilesh, a lot of people are actually thinking, is at least the banking crisis has it ebbed? Will it just kind of stay here? And can we get on with, planning the rest of our money deployment? Or could there be more issues, whether it's in the US or whether it is in Europe for that matter? What would you say to this concern?
The US has more than 3,000 community banks where following prudential norms was optional. What Indian bankers live daily, like liquidity coverage ratio, high quality liquid assets, asset liability matches, net stable funding ratio, all this were optional for American banks. For example, SVB put 45% of their balance sheet in held to maturity portfolio where there was no need for mark to market. Even though mark to market losses were in excess of their net worth and they were technically bankrupt, they didn't have to disclose that. Now, this means that there will be more SVBs in US. Banks which followed prudential norms, they will be safe. Banks which took chances, took risks, and didn't follow prudential norms, they could be casualty, just like SVB or First Republic or Signature Bank. Out of 3,000 banks, it will be unfair to assume that 2,997 will have followed prudential norms and only 3 have not followed.
Okay, I think that's saying a lot, and I think we have to read between the lines and just basically be prepared. But Nilesh, I want to go away from this entire chat about Western banks blowing up because let's face it, even before this crisis hit us, and by the way, even now, I mean, if someone just looks at the data, the Indian market is still underperforming. The Dow is only down about 1.5%, 2%. A lot of the European markets are still up about 6-7% despite this crisis playing out. So, Nilesh, coming closer home to the issues here, even before all this happened, we were talking about corporate earnings slowing down. We were talking about underperformance. We were talking about issues around inflation, etc. So then how do you look at the Indian market? We had the Adani issue, of course. How can I forget that? So then how do you look at the Indian market purely going by our local agenda and our local issues?
So if you take longer term view, then markets are like weighing machine. Your fundamentals will determine the prices. IMF believes will become third largest global economy by 2028. Some English institute believes will become by 2032. But everyone believes that India will become third largest global economy and will continue to rise thereafter. So if you take a longer term view, there's no doubt in my mind or anyone else's mind that this is the country on the way up. I'll give you some interesting data. 6 out of top 10 fastest growing cities of the world last year were in India. Our cities are growing fastest in the world. Number two, there were only two economies in this century, China and India, who have grown relative to US economy among major economy. Be it Germany, be it Japan, be it UK, be it France, they all have come down relative to American economy. Only China and India has grown. This is last 21 years. Over next 21 years, also this equation is likely to remain the same. So you are investing in an economy which is going to grow faster than most of the economies in the world. The third thing is our corporate ambitions. Now forget about listed company because they are likely to make tall claims. But I'm talking about a cooperative society run by rural Indians, run by Indian milk producers, run by Indian farmers. Amul is India's largest FMCG company with $7 billion turnover. That's about 10% of world's largest FMCG companies' turnover. They have stated that by 2047, they would like to become world's largest FMCG company.
Sure.
Now, this kind of ambition, if they deliver, you can imagine what will be the growth.
No,
So long-term India story, absolutely no one.
And no one is debating that at all, Nilesh. It's just that investors get a little jittery and sometimes impatient as well, as you said, because, there has been a, over 15-month waiting period now in terms of flat to negative returns. So let me come back to the house call that you folks have at Kotak. And let me start with a very basic question. If today you had 100 rupees to invest, how much would go to equity? How much would go to maybe fixed income? I don't know if you'd put some to gold as well. What's the breakup?
Surabhi, one line answer: go and invest into asset allocator fund and leave the responsibility of dividing between debt, equity, and gold onto the fund manager. Most of us live such a busy life that we are not able to take right asset allocation decision. Give that responsibility to the fund manager. There are various kinds of asset allocator fund available. They give you choice between debt and equity. They give you choice between debt, equity, and gold. That fill it, shut it, forget it kind of funds will be the most appropriate. If I had 100 rupees, I will invest into that fund. And let professionals manage my money.
Fair enough. Okay, so let me now go specific to the equity part of it, the equity asset class. And here, I mean, a lot of our viewers have been asking plenty of questions as well. In fact, I'll try and squeeze in some as we go forward. I think the one issue that everyone is grappling with is what do you do? Now, bank stocks are selling off, though everybody knows on the street, a lot of investors know there's no correlation, but banks are selling off. There is a concern around IT because of exposure to the US. So just purely in terms of the house call, within equities, what do your colleagues on the investment side, what are they recommending, and what is the preference for the next several months?
So our recommendation is this is fair value market. Don't be overweight equity. Don't be leveraged into equity. And there's so much of volatility. Please don't dare to trade unless until you are certified professional. Second, try to keep some dry powder so that you can buy during correction if events happen that way. Third, be marginally overweight large cap and marginally underweight small and mid cap, and try to buy small and mid cap during correction. And most importantly, please take a longer term view. From here till May 24, there are many events which are staked up. What will happen at US Fed? What will happen in India's general election? What will happen to energy prices thanks to Russia-Ukraine escalation? There are so many events which are likely to keep markets volatile up till May 24, and hence take a longer term view.
Okay, so take a long-term view, fair call. And Nilesh, as we are winding down, give us one money-making idea. I mean, it could be on, in terms of a theme, a sector. A lot of people are very positive on, for instance, the capex recovery, and some of those stocks have done well. It could be on the fixed income side. I mean, there's a lot of confusion about what kind of funds or what kind of securities to get in, given the volatile rate environment. So, any thoughts?
So, for investors who are willing to take risks, I believe manufacture in India stroke infrastructure fund should outperform the market over next 12 to 18 month horizon. On the investment, on the fixed income side, I'll recommend duration fund. In 2023 first half, we might see interest rates moving up a little bit. But come 2023 second half, stage will be set for global interest rate reduction, and hence by longer term duration. So income, go for duration, equity, take risk on infrastructure, so manufacturing theme.
Okay, all right, great. We really appreciate you giving us some of those ideas. Let me end by asking you a question that I know you won't want to answer, but let me ask it anyway. Where do you think the Nifty is going to be on the 31st of December 2023?
It will fluctuate.
Fantastic reply, Nilesh. It's been a pleasure having you on the show, and I think that really says it all. We are in volatile times and in volatile markets, and we need to plan and prepare accordingly. Thank you very much for being with us and sharing your viewpoints on the investment horizon in this climate. All right, well, we hope you found that conversation with Nilesh Shah fruitful. That's it on today's episode of Who Moved the Market. We'll see you with another theme tomorrow.